Hello and welcome to Digital Accounting Education, a channel that strives to make accounting and EMS easy for you. Don't forget to subscribe and comment down below what other topics you would like to see from me next. So let's get into today's video. So in today's lesson, we are doing the statement of comprehensive income, which is the income statement. So it says Mokwana Traders. The following information relates to the financial year ended on the 29th of February 2024. And you are required to complete the statement of comprehensive income, which is basically the income statement. Okay, so let us look at our information. We have information A. Information A is an extract from the pre-adjusted trial balance on the 29th of February 2024. So now what you need to know is that with the information that you find in the pre-adjustment trial balance is all the amounts that are not yet finalized. So it means now these marks are either miscalculated or some of the amounts are omitted or there's just something missing with the amount. So most of them are not final amounts, which means you must find additional information which will tell you what to do to adjust these amounts so that we can have the final amounts which will go into our income statement, so that our net profit for the year can be a true reflection of what really happened during the year. Information B is additional information and adjustments. So this is where you read about whatever accounts that need to be adjusted and then you do as told. Then you will have your answer sheet that will already be given to you. So it says here statement of comprehensive income for the year ended 29th February 2024. So as you can see in the answer sheet, there is already some accounts that have been entered for you, and the amounts are written in brackets to show that you need to adjust these amounts. Now here's a piece of advice. Whenever you get a question paper and you have to do statement of comprehensive income, this is what you have to do first. Go to your trial balance and highlight your incomes and your expenses. This will help you to not forget all the accounts that do not need adjusting. Because if you go straight into your adjustments, you're going to forget the accounts that do not need adjusting, which were given to you in the trial balance. So we are going to start with identifying our incomes. So I'm going to highlight our incomes. So the first income that we see here is sales. So now with sales, it says sales including 50% markup. Okay, so sales and cost of sales as well, we use them to calculate the gross profit. So now you can see here that with sales, it says including 50% markup. So if you can look at our cost of sale, it is not given. Okay, meaning you have to use the markup to calculate the cost of sale. Okay, so now we move on to the incomes. The incomes, I will use a different highlighter. So we have rent income, we have commission income, we have discount received, and those are the two incomes that I see. Okay, so now someone can argue and say interest on fixed deposit. Interest on fixed deposit is an income, however, it is an interest income. And in our statement of comprehensive income, there is a section for interest income. So that is where your interest on fixed deposit will go. I will just show you now. So my expenses, if you can look in the balance account section, we have provision for bad debts. That is an expense. And then we have salaries and wages, consumable stores, insurance, sundry expense, and bad debts. So after you highlight your incomes, you're going to go into your answer sheet and transfer all of these that you have highlighted, and you put the amounts in an open bracket. So you're going to do the same way they did in the answer sheet. So you can see that sales, they already transferred the amount for us. Cost of sale, we don't have an amount, but we have the sale amount and the markup percentage. We can use those to calculate our cost of sale. But let us just wait to see what is happening in the adjustments so that we can see if our sales need to be adjusted. But if you see it like this, in the bracket already, they are telling you that the sale amount need to be adjusted. So we move on to our operating incomes, other operating incomes. The first one is rent income for 143,750. And then the second income we have is commission income. open bracket, you transfer the amount 22,480. The last one we have is discount received. Open bracket, you put in the amount 7,270. So now at the end of your statement of comprehensive income, if there's any account which did not need any adjustment, then you just take the amount and you transfer it to the amount columns. So now we go back and we check our operating expenses. So operating expenses are highlighted in red. First one is provision for bad debt. Second one is salaries and wages. Consumable stores for 11,900. Then we have insurance for 19,300. We have bad debts already. And then they gave us trading stock deficit. Then we have sundry expense. Sundry expense, if you can see, they didn't give us any amount, which means we have to calculate the sundry expense ourselves. The bad debt has already been given to us. So now you transferred your operating expenses. We move on to that interest income that we saw in the trial balance. Here is the interest on fixed deposit, which is our interest income. You go and you also transfer it. So our interest incomes will be just under operating profit. Okay, so it is going to be interest income of 8,500. Okay, so now we go to our adjustments and see which accounts need to be adjusted. Okay, so the first adjustment says credit note of damaged goods worth 5,375 with a cost price of 2,500 was not recorded. Okay, so now this adjustment is loaded. Okay, why? Because it affects a lot of accounts. Okay, so now what is this credit note that they're talking about? So in accounting, you need to know these terms and the source documents that are used so that you do not get confused. Okay, so now a credit note is issued by the business when they have to reduce the amount that is owed to the business by the debtor. Okay, so they reduce the amount due to the goods that have been returned to the business by the debtor. And if that debtor was owing us 500, for example, and they return the goods worth 200, it means now we have to credit their account to say that they no longer owe us the 200 rands. So now what accounts are actually affected by this credit note? Number one account will be the debtor's control. Why is the debtor's control affected? It's affected because we have to now minus this goods from the debtor's control. Debtor's control, remember, is the amount that is owed to us by all our debtors. So if one debtor has returned something, it means that amount also has to be minused or subtracted from the debtor's control account. So the second account which is affected by this credit note or by this adjustment will be the sale account. Why? Because we had counted these goods in the sale because we had made a sale. So if we said the total amount of sale in the business was 10,000, for example, and a debtor returns some of the goods, we have to now minus or deduct that amount from the sale account because it is no longer counted as a sale. Another account which is affected will be the cost of sale. Because remember, when we make a sale, we always have to calculate the cost of that sale so that we can also count it as our cost of sale. So those are the three accounts which are affected by this adjustment. So now you go to your adjustment A. So in the debtors control, you're just going to say, now the 70,000 that we have been expecting from our debtors, we have to subtract 5,375. Why? Because we are no longer expecting 5,365 from our debtors since the goods for that amount have been returned to us. Second account, which I said will be affected, will be the sale. Okay, so let us go to our income statement so that we can adjust it in the income statement. Okay, you get to your sale amount, okay, which is already entered for you, and then you subtract the goods that have been returned. And the goods were 5,375. Okay, so now I said the other account which will be affected is the cost of sale. Okay, so now we have to go to the cost of sale, and what we should do is we should minus or subtract the 2,500 from the cost of sale, since we should not account for it anymore. So if you go to your trial balance, you remember that our cost of sale, we did not have any amount in the cost of sale, okay? However, we have an information here that says our sales includes 50% of the markup, okay? So we can use this sale amount to calculate the cost of sale. So you go to your statement of comprehensive income and you calculate the sale amount. So it's going to be 1,350,050 minus 5,375, which gives us a new sale amount of 1,344,675. Okay, so that is our new sale amount. So now to calculate the cost of sale, you're going to use that formula that I have given you in the other video, which I will link it down below. So you're going to say 1,344,675 multiplied by 100, because we are looking for the cost, divide by 150. So this will give us 896,450. Okay, so if you don't understand this method, which is the easiest method, just check out the video linked down below, and it is also appearing right now on your top right. Okay, so what I don't want you to forget is that our gross profit has to be calculated. And how you calculate your gross profit, it's going to be the sale minus cost of sale. So now your cost of sale must be in brackets to show that you are subtracting it. So you're going to say your sale amount minus your cost of sale, which will give you 448,225. So now remember, in the first adjustment, they said that damaged goods were returned to us or to the business and it was not recorded. Okay, so in the trading stock deficit, you have to show that that damaged stock is not with us anymore in the business. So after calculating your gross profit, remember that the cost price also has to be accounted for. So now this 2,500, if the goods were not damaged, we were going to add it into the trading stock to say that the goods have been returned back into our trading stock, but now they are damaged. Okay, which means now we have to show that we don't have the stock anymore in our business, since we can't sell it anymore. So how do we now write it off? We are going to add it to our trading stock deficit. So we are going to go to our trading stock deficit and add this 2,500 to show that this is the stock that has been lost due to damage. We go to the second adjustment, which says physical stock take revealed that stock with the cost price of 4,200 was missing, and consumable stores on hand amounted to 3.1. So now they are talking about two things here: trading stock and consumable stores. Let us first talk about stock. Okay, so now they are telling us that when they were doing physical stock count in the business, they actually found that stock that is worth 4,200 has went missing. Okay, which means now the stock that is accounted for in our books does not match what we have in the business. So now we have to write off this stock to say that the stock is not in the business anymore. Okay, so now what we are going to do is we are going to add it to our trading stock deficit. So we are going to say trading stock deficit. Here is more stock that has went missing worth 4,200. Okay, so we move on to consumable stores now. And it says consumable stores on hand had amounted to 3,100. Okay, we go to our income statement. So I don't want you to cram these things. I want you to understand the terms and what is exactly happening here. So now, what are consumable stores? Consumable stores are utilities or items that the business buys just to use during the operations. Okay. And things like maybe stationery, the pens, the paper, the markers, the ink, and cleaning supplies. So those are the things that we consider as consumable stores. Okay. So now the amount that you get from the trial balance, that amount is the total consumable stores that have been bought, okay, for this financial year. Okay, so now when they say that consumable stores have been left off, or when we counted during our physical stock count, we counted that 3,100 of consumable stores were left over. It means that the 3,100 worth of consumable stores were not used out of the 11,900. Okay, so we have to now subtract the 3,100 from the 11,900 to say that this is the consumable stores that has not been used in this financial year. So it was definitely not an expense for this year. Okay. And then we move on to the next adjustment. The bookkeeper left out a discount of 230 from Angel Traders, a creditor. This was for early payment of the account. So now, discount that we receive is an income, which means you have to go to your incomes in the income statement. So in your incomes, we already identified discount received, which was 7,270, and the bookkeeper did not record the 230 that we have received of discount. So you just go and say we received discount of 230. So you add it to the discount received. Adjustment number 4 says debtors with areas of 3,000 must be written off. So what happened here is that we had debtors that we've been trying to get our money from, but now we are giving up on them. So we are no longer expecting this 3,000 from them. So we are writing them off and we are taking our L. So what accounts are affected here? So remember, these are debtors, right? We have the total debtors, which means now the 3,000 was in the debtors control account to say that we are expecting 3,000 from our one of our debtors or some of our debtors. So now we are no longer expecting it. We must go to the debtors control account and subtract the 3,000. So your debtors control account is in information A. So you go to your debtors control account and you say minus 3,000. So we are no longer expecting the 3,000 from our debtors. So now when we write off the debtors who are not going to come back and pay us anymore, or whom we are just giving up on, those type of debtors, we call them the bad debts. Okay, which means this 3,000 must now go and be added to the bad debts. Okay, we had bad debts of 4,120, and guess what? We are not also going to get our 3,000 back, so it must be added to the bad debts as well. So you say bad debts plus 3,000 to the amount that has been given to you. Next one is provision for bad debts, number 5. So it says provision for bad debts must be adjusted to 4% of debtors. So now with provision for bad debt, what exactly is provision for bad debts? So now remember, when you sell on credit, it's not everyone who's going to come back and pay you. Okay, so if you are selling on credit, you need to have provision for bad debts. Okay, how I usually explain it easily to my learners, I usually just say that provision for bad debt is room for disappointment. Okay, so you're saying, for example, your total debtors amount to 10,000. Okay, and you're putting room for disappointment of 2%, and you're saying that 2% of these debtors might not come back to pay me. Okay, so now the amount of provision for bad debts that you find in the trial balance, this amount over here, this amount of 2010. So now what happened is that at the beginning of the year, when we came into this financial year, we said that, okay, we have this many debtors, okay? And remember, we have to put away room for disappointment, okay? So now we said that out of all the debtors that we have in the business, we might not get back 2010. So now we are at the end of the year, and an adjustment is saying to us that, oh, there have been changes in provision for bad debts. So actually, provision for bad debts has to be 4% of our debtors. That's what the adjustment said to us. Okay. So now we have to calculate and see that is the 4% of our total debtors amounting to 2010 or not. And then if it is more than the provision for bad debts we have actually put at the beginning of the year, it means that is an expense. It means now our debtors have disappointed us more than we expected them to disappoint us. Okay, so if now when we calculate the 4% and it is less than the provision for bad debts we had put at the beginning of the year, it means now we got more money back from our debtors than we had anticipated. So it means we must now reduce our provision for bad debts, and that will be an income. So let's calculate the 4% of our total debtors. Okay, so this is where the debtors control comes in. If you had not subtracted these amounts from the debtors control, you were going to use the 70,000 to calculate your percentage for provision for bad debts, which will be wrong because there had been adjustments to our debtors control. One has returned damaged goods, and the other one was debt that we are writing off. So you go into your calculator and you calculate the new debtors control amount. So you're going to say 70,000 minus 5,365, 75 minus 3,000. And then it gives you 61,625. This is your new debtors control amount. So your new debtors control amount is 61,625. So now to calculate our provision for bad debts, we are going to say debtors control. Remember, they said that provision for bad debts must be adjusted to 4% of debtors. Okay, so you go to your debtors and you calculate 4% of it, which means you will say the new debtors amount multiplied by 4%. So multiplied by 4%, 2,465. 2,465. So now I said to you that if our provision for bad debts is higher than what we had, then it means that would be an expense, meaning that we expected our debtors to ghost us less money, and they actually ghosted us more money than we had anticipated. So now we must add that difference to the provision for bad debts. So now what is the difference? You're just going to say 2,465 minus 2010, and you get the difference. It would be 455. So this is the difference that you have to account for. So in the beginning of the year, we expected not to get 2010 from our debtors, but actually we did not get back 2,465, which means the difference should be added to the expense. So you say 210 Okay, so our adjustment has to be 2,000. So our adjustment has to be 2,465 minus 2010, and you will get your 455. So this is the expense that we have to add. Okay, so the next one says insurance of 9,300 was fully recorded. The amount was paid for the period of 1st of January to 30th of June 2024. So now the key word here is the amount was fully recorded. If you check in our trial balance, we are given an insurance amount of 13,300. So when they say it was fully recorded, it means that amount of 9,300 was actually recorded in the 19,300. So now this amount of 9,300 was for insurance of the 1st of January to the 30th of June. So now remember, our financial year ended on the 1st of Feb 2024, which means it started on the 1st of March 2023. So this is the financial year that we are working with. So every amount that we are accounting for should be the amount that falls into this financial year. So how do you now calculate it? We are going to try and subtract the amount that does not fall into this current financial year because it was already recorded. So how do we find it? 9,300 was for January, February, March, April, May, and June. That's for 6 months, okay? So it means now you're going to divide it by 6 so that you get the amount for 1 month. So you will get 1,550. So this is the amount for 1 month, okay? And we have to subtract the amount for the other months which are not in this financial year. So how many months actually fall into this financial year that have been fully paid for in this amount? So they paid for January up to June, and in this financial year we only have January and February because this financial year ends on the 29th of February. So only 2 months fall into our current financial year. So we have to take out the other 4 months. So you times this amount for 1 month by 4, okay? And then this will give you 1,550 multiplied by 4, 6,200. So this is the amount for the insurance for 4 months which are not in the current financial year. So you take the 6,200 out of our insurance amount. So you go to insurance, you say minus 6,200. Okay, the next one says rent income was increased by 10% on 1st of September 2023. The rent for February 2024 has been received. Okay, so I know with rent income, it gives a lot of learners problems, especially when we are working with increased amount of rent, especially when working with percentages. So here's how you do it. So they are saying that rent increased by 10% from September 2023, right? And remember, our financial year started on 1st of March 2023 and it ended on the 29th of February 2024. Okay, so you just have to do your timeline. Okay, so now our year goes like this. So it's March, April, May, June, July, August, September, October, November, December, then we have January. Okay, so this is our financial year. Okay, so what they're telling us is that our rent increased from September 2023 by 10%. Okay, so now it means we don't know how much it increased by, we just have a percentage. Okay, so now what you're going to do is that you're going to go to your trial balance. In your trial balance, you have rent income of 143,750. And in your adjustment, the only thing they gave you was the percentage. So we don't know the amount it increased by, the amount after the increase, and the amount before the increase. We have to find that out. So now let us just say the old rent that we don't know is called X. Okay, so now we are going to solve for X. I know if you're not doing maths, you're screaming already in your head right now, but bear with me. It's actually easy. So we are going to call our old rent X because we have to find the old rent so that we can find the increase. So before the increase, so the increase was actually in September, meaning from September all the way to February, the rent was more than the actual amount. However, from the 1st of March to August 2023, the rent amount remained the same. So here the amount was X, okay? And how many months did these people pay the X amount? So it was March, April, May, June, July, and August. So that was 6 months, okay? So from March until August, we have 6X, okay? 6 for 6 months, X is the amount that we don't know. Please remember that in the adjustment, they said that the rent for February 2024 has not been received. Okay. So now, how many months did these people pay the rent with the increase? So it was September, October, November, December, and January. So these are the amounts with the increase. So it was 5 months, and they were paying the X amount, which was actually 110%. Okay, why am I saying 110%? Because the 100% is the actual amount, which is the original amount, but they paid 110% because their amount was inclusive of 10%. So it was the original amount plus the 10%, which makes it 110%. So the 5 months of X amount times 110%. So if they give you any other percentage, it means it's going to be 160% if it's the 60% increase or whatever percentage that might have been given to you. So February, we are looking for the amount for February. We don't know how much that amount is. Okay, so the amount that we have in the trial balance is 143,750. Okay, so now we are going to make an equation. Okay, before we make an equation, I want us to simplify the amount with the increase of the months that have an increase. Okay, so it says here 5x multiplied by 110%. Okay, so now it's going to be 5x multiplied by 1.1, okay, because 110% equals to 1.1 when you simplify it. So which means it's going to be 5.5x. Okay, so now we have 6x and 5.5x in the question mark. So now what we have here is that the 6 months of the amount we don't know plus the 5.5x amount months of the amount that we don't know equals to 143,750. So in this amount is the 5 months that includes the 10% and the 6 months that do not include the 6%. So we are trying to solve for this X. We are trying to get the amount for the X. Okay, so we can know what the actual amount was. So we try to solve for X. So you're just going to add the 6x and the 5.5x. It will give you 11.5x equals to 143,750. So now when you have an equation like this, we are trying to solve for x, meaning we want this x to be left alone on this side. Okay, so you're just going to divide the both sides with 11.5. What this does is that it cancels out the 11.5. So if you want to remove this amount, you just divide it by itself. So it means now this side you're left with the x, and then on the right hand side 43,750 divided by 11.5, 12,500. So it means now our x, we finally found our x amount of 12,500. Okay, so now what we know is that right now we are trying to find the amount for February 2024, because remember, even though we did not receive it, we have to add it because we have to calculate all the amounts that should be paid or received in this current year. Whether we have received them or we have paid them, we have to account for them. So now this X amount is without the increase, and they said to us that in September the rent was increased by 10%, which means now the rent for February 2024 has to also have the 10%. So you're just going to say the money for February, which is the question mark, multiplied by 110%. Okay, because you want the amount that is inclusive of the 10%. So this, you put it in the calculator and it will give you 13,750. So this is the amount with the increase for 1 month. Okay. So you go to your income statement and you go to your rent income and you add the amount for February that was not received. So it's the amount we just calculated and it will be 18,750. We move on to the next adjustment. It says the bookkeeper recorded 80,500 as additional fixed deposit on the 1st of October 2023. Okay, so you must first understand what happened. So we made an additional deposit, or the business has made additional deposit of 80,500 as additional fixed deposit in October 2023. Okay, so what we are actually looking for here is the interest, because we are doing the income statement. If you go and look in your trial balance, you will see that you have a fixed deposit of 180,000 and you also have the interest on fixed deposit of 8,500. Okay, so now the deposit that we initially had at the beginning of the year is 180,000, and this 180,000 must earn interest of 12% for the whole year. So now 12% of 180,000 is 21,600. So this is the amount that should be earned as interest in this year. So if you look in your trial balance, they said we only received fixed deposit of 8,500, which means now there's an amount that is missing, because when we calculate the interest that we're supposed to earn is actually 21,600. Okay, so now you have to add the difference. So you're just going to say the amount of interest we had to receive minus the one we already received, which is the 8,500, and then you're going to get 13,100. Okay, so you have to add this amount. Remember, I said income statement, you account for the amounts that had to be paid or received in this year, no matter if we have received the amounts or not. So you go to your interest income and you have to add the 13,100. So in your adjustment, what they said to you is that we had 80,500 additional fixed deposit on the 1st of October. So now remember the timeline, okay? So 1st of October was when we made additional fixed deposit. So we have to calculate the interest on that one as well, because there are months that already fall into this financial year that we have to receive interest on for this year. So we are going to say 80,500 multiplied by 12%, because remember our fixed deposit earns 12% interest. Okay, but this interest is for the whole year. So we are not going to leave it at 12% for the whole year, because the 80,500 had not been deposited for the entire year yet. So we only had this 80,500 additional fixed deposit from October, November, December, January, and February. That's 5 months. So we are looking for the interest income of 5 months that is within our financial year. So you're going to say times, okay, 80,500 times 12% multiplied by 5, because we are only looking for the interest of 5 months. This will give you 4,025. You must just put it in your calculator. You go to your interest income and you add the interest for the additional fixed deposit, and that was 40,025. Depreciation for the year amounted to 68,750. So they're just telling you what the depreciation for the year amounted to. So you just go to your operating expenses and you add it. So the depreciation was 68,750. Doesn't have any adjustment to it. So the last adjustment says the loan statement is as follows. The balance on the 1st of March 2023 was 385,000, and the repayment of loan including interest was 265,000. Okay, so this amount includes the interest on loan. So the balance on the 29th of February 2024 was 184,500. So what they are basically telling us is that at the beginning of the year, we were owing a loan amount of 385,000. And then we made a repayment of 265,000. But in this 265,000, there is interest on loan. And then at the end of the year, we had loan amount of 184,500. So now we are trying to find how much interest has actually been paid. Okay. So if I had 385,000 worth of loan in the beginning, and at the end I had 184,500, it means the difference is the loan amount that has been paid, 200,500. So now the 200,500 is the amount of loan that was actually paid. But they said that the total repayment we made for the loan, which includes interest, it's 265,000. So it means the difference between these two amounts is the interest. Okay, so you will say the 265,000 that we paid minus 200,500, it will give you 64,500. So now this 64,500 will actually be your interest on loan. So the interest expense will be 64,500. So just underneath our last adjustment, they said NB. Operating expenses amount to 28% of the adjusted sales. Okay? So we already adjusted our sales, and they are saying to us that operating expenses is 28% of our adjusted sales. Here's our operating expenses. So you are going to say 1,344,675 multiplied by 28%, and you will get your operating expenses amount, 376,509. So now just don't forget to calculate your incomes and your expenses. So now you are done, and you must just put in the amounts in the amounts column. Salaries and wages did not have an adjustment. So had you not copied it from the trial balance earlier on, you would have forgotten about it right now when we have to total our income statement. So now that you have it in here, you just say the amount of salaries and wages, you put it in the amounts column. And then you calculate consumable stores, 11,900 minus 3,100 would be 8,800. The insurance will be, just make sure you put it in your calculator, 13,100. Bad debts would be 7,120. Trading stock deficit, 129,200. And then we have the sundry expense, which has to be calculated. So now we have our operating expenses, which has been given to us through the 28% of sale. We calculated that. So now what you know is that all these are expenses, or they are operating expenses, right? Meaning when you add the operating expenses, you need to get this amount. So now this amount, we do have it. So to get this missing amount of sundry expenses, what do you have to do? You guessed it right. You have to take the total and you minus every single amount in here, and it will give you the sundry expense. So the sundry expense would be 376,509 minus all the other operating expenses, and it will give you 43,484, which is actually a balancing figure. Okay, so now we need to calculate our rent income and other incomes as well. Our rent income would be 157,500. Our commission income will be 22,480. And then discount received will be 7,500. So you add them together on your calculator, they will give you 187,480. So now you have your gross profit and your other operating incomes. So you add them together to get your gross operating incomes. So that would give you 637,730. Okay. And to get your operating profit, you're going to take your gross operating income and you minus or you subtract your operating expenses. So you say 637,730 minus, that would give you 261,221. And then your interest income, you have to finalize the amount, and that amount would be 25,625. Remember, you get it from adding the amounts in the bracket. And then for you to get your profit before interest expense, okay, I see that we wrote interest expense amount at the wrong place. So your interest expense was 64,500. Apologies for that. So we have to calculate our profit before interest expense. So for you to get your profit before interest expense, you add these two amounts, the operating profit and the interest income. And that would give you 286,846. Okay. And then your interest expense must be in the bracket so that you can subtract it. So you will say your profit before interest expense minus your 64,500. And then your net profit for the year would be 222,346. We have come to the end of our lesson. Please make sure that you subscribe so you don't miss future videos. Also, please text the number below so that we can help you in preparation for your exams.